Okay, let's dive right in. In this analysis, we're breaking down a structural condition in the global silver market that has, frankly, developed almost completely beneath the radar of conventional finance. Our examination is grounded in hard data, primarily from the United States Geological Survey, and it points to a pretty significant market shift. Our analysis really starts with a single critical data point that mainstream commentary has largely overlooked: 22%. 22% of the world's known silver reserves are controlled by just one nation. Now, this isn't some trivial statistic. It represents a foundational shift in who holds the power over a strategic industrial commodity.
So this level of concentration in a metal this important creates a structural market condition that really requires a closer look. You have to ask, who is it? Identifying this nation is the very first step to understanding the pressure that's building up within the physical silver market.
Now, the holder of this stake is not one of the typical economic superpowers you might think of, and that's what makes the situation all the more significant. It's a South American nation, Peru. That single fact completely reframes the entire geopolitical map for strategic commodities.
So, to really understand the implications here, we first have to map out the geographical distribution of these reserves. The latest data from the USGS gives us a crystal clear picture of who controls the silver that's still left in the ground.
So, what's really interesting when you look at the data is that Peru holds a commanding 22% position. But look at the next tier down. You've got Australia, Russia, China, and Poland. And together, they control another 49.5%. You add that up and it means over 70% of all known silver reserves are concentrated in just 5 countries.
Okay, and this is an absolutely critical distinction we have to make. In-ground reserves are not the same thing as actual market supply. Reserves are just geological potential. It's what we know is there. But the capital, the time, and the infrastructure needed to turn that potential into actual metal you can hold, that is the central tension driving this entire market. And this brings us to a core vulnerability in the market. The world's biggest producer of silver right now is Mexico. But here's the paradox. They're pulling silver out of the ground at a rate that's way faster than they're confirming new reserves. This creates a producer paradox. The very country supplying the most silver is also facing a depletion crisis, and that threatens the stability of the entire supply chain.
All right, so let's move over to the demand side of the equation and see how this all builds into a much larger structural issue. The nature of silver demand has gone through a fundamental transformation that I'd argue the markets have not yet fully priced in.
You know, silver's demand profile has completely shifted. Decades ago, the collapse of photographic demand led a lot of people to believe that silver's industrial relevance was basically over. Well, they were wrong. A brand new supercycle, driven by green technology and electrification, has emerged. The growth here is just exponential. Demand from the solar sector alone has more than tripled in less than 10 years, from under 50 million ounces a year to over 160 million ounces. And this is not cyclical demand. This is a long-term secular trend that's reinforced by binding government policies all across the globe. And it goes way beyond solar. Escalating EV production, 5G infrastructure, strategic defense applications, all of these are adding multiple non-cyclical layers of industrial demand. And unlike, say, discretionary spending, this kind of demand is largely recession-resistant because it's tied to long-term industrial and geopolitical goals. If you think our analysis is good, please like, forward, and subscribe so you don't miss out on what's next. So now, let's connect that really robust demand picture back to the realities of supply. This is where the core structural deficit, which has been running for years, by the way, becomes starkly apparent and really poses a significant risk. Here's the crucial point. Bringing new reserves to the market is an incredibly capital-intensive and time-consuming process. The average timeline, from getting a project approved to seeing significant production, is 7 to 10 years. There is no switch you can just flip to get more supply. This gap right here defines the market's supply inelasticity. It means production can't be rapidly increased to meet sustained demand growth or any sudden supply shocks. So those enormous reserves sitting in Peru, they don't solve today's supply-demand imbalance. This persistent deficit means the market has been drawing down existing above-ground inventories just to fill the gap between what the mines produce and what industry consumes. The problem is, these inventories are finite, and the deficit is widening, not closing. So when you synthesize this entire analysis, we can identify 3 primary risks that stem from the current market structure.
These are really the key takeaways for any industrial consumer, policymaker, or investor to consider right now.
So these three factors basically form a triangle of risk. First, geopolitical leverage. That high concentration of reserves we talked about creates potential supply choke points. Second, extreme supply inelasticity. As we've seen, that long mine development timeline means supply just can't respond to demand. And third, top producer depletion. The world's leading producer, Mexico, is facing an impending reserve crisis. Any one of these could trigger a significant repricing event. All three of them together represent a formidable challenge.
So, the data doesn't point to some temporary imbalance. It points to a long-term structural condition. The question is no longer if the market will react, but how it will reevaluate a metal that is simultaneously a monetary asset and an absolutely irreplaceable industrial commodity. This is the core issue that's going to define the market for the next decade.